good morning, everyone, and thank you for joining us today. I hope all of you are keeping safe and doing well. We'll just start with the session now. I think everyone working in taxation will agree to one thing that the only constant in taxes is change. And the UAE tax landscape has once again proven the same in 2026. 2025 was a busy year for all tax and other professional or finance professionals with first time corporate tax compliances. And we would think that FTA forgot VAT, but not really. FTA ensured that we have enough excitement in VAT as well. So there were several important changes that impacted VAT compliances that were introduced towards the end of 2025. Some of these changes have already been effective from January 2026, but still are very, very important, and others are will be effective from 14th April 2026. So in today's session, we will walk you through the key updates and amendments that businesses should be aware of, focusing particularly on the areas that could have practical implications. So there are a lot more amendments, but we have kept our focus more on the changes that actually impact the businesses. Our goal today will be to break these developments down into simple, actionable insights so that by the end of this session, you have a clear understanding of what has changed and what businesses should be doing next. So in case any of you have any questions during the session, please feel free to message or put them in the Q&A box, and we will take all of them up at the end of the session. Before we begin, let me briefly introduce Premier Brains. We are a UAE headquartered professional services firm with over 14 years of presence in UAE, in the region rather. In the UAE, we have offices across Dubai, Sharjah, and Abu Dhabi. And our regional footprints actually extend to Oman and Saudi Arabia as well. So we are also an independent member of Audit Trust International. We work across a wide range of industries, supporting them through multiple services, including audit, tax, internal audit, advisory, and all the services that a professional service firm offers. As I mentioned, our regional footprints are not just restricted to UAE. We have offices across in Saudi Arabia and Oman as well. To give a little bit of brief on our management, the firm is led by our very dynamic managing partner, Mr. Rishi Chawla, who is also the vice chairman of ICI Dubai chapter. We have four other partners for UAE practice who all come from a big four background and major industries. This background of the management helps us ensure strong technical expertise, and also it ensures that we have global best practices into the firm, and so that our quality of advice and deliverables always remain consistently accurate and high. About the speakers for today, the session will be held by myself and Aditya. I am a chartered accountant with more than 10 years of experience into taxation, majorly for GCC and APAC region. Aditya is also a chartered accountant, and he comes with 7 years of rich experience into taxation of direct and indirect both. Both of us have been associated with leading tax advisory firms in the past, and we have catered to various clients in multiple industries across GCC and APAC region. So this is it about for the firm and ourselves. We'll now dive right into the agenda. Just to talk a little bit about what we'll be covering today. Some of the very important topics that we'll be covering today are, first is a refund or excess recoverable tax, and I think this is the most talked topic as of today. Then we'll be talking a little bit about the timeline of tax audit and the statute of limitation and some exceptional scenarios when you could have audit even beyond a period of 5 years. Some specific cases where FTA has now released when input tax can be rejected, which was not earlier in place. Then Aditya will be talking a little bit about the changes in administrative penalties, and this is also a very important change. Then we'll cover a little bit about the reverse charge, a slight change in amendment in reverse charge provisions, and a new reverse charge that has been introduced for metal scrap trading. To start with, excess recoverable tax. So many of you already understand it, but just for the larger audience, I'll brief that usually when we see excess recoverable tax appearing is when our return has more input tax credit than output tax credit. And that is the general understanding that people has when an excess recoverable tax could come or when a return could be in a refundable position. So up till now, there was no time limit on the time limit on the time frame within which a refund could be applied, or any recoverable tax that you had in the account could be utilized. But with effect from 1st January 2026, FTA has now put a timeline on it, and any excess input tax can be carried forward only for a period of 5 years from the tax period to which it relates to. So now suppose we are talking about a tax period where for a refund where the tax period ended January 2022. That credit can only be either utilized or carried forward till January 27. After that, the credit lapse. Now, this is just one example. You could have recoverable tax for other reasons as well. There's a possibility that you ended up making payment twice for the return, and that credit ends up lying in your excess recoverable tax. In that case, even in that case, the 5-year tenure applies, although it's a pure cash flow that flew from your pocket. In that case, the 5-year tenure is applicable from the date the payment was made. In there could be another scenario. Suppose you filed a return and then where you had either a payable position or a lesser credit available, and then you ended up filing a voluntary disclosure maybe 3 years down the line, and you had more credit to your account. In that case, the 5-year tenure will apply from the date of filing voluntary disclosure. Or in case there could be another possibility that you were audited and that led to either increase or decrease in credit, again, or in increase or decrease in recoverable tax. In that case also, the 5-year tenure applies from the date the assessment was issued. So now, with this amendment, there could be a few questions in the mind of registrants, because even we have clients where the input tax credit has been lying in the account since 2018. So just to cover that gap, FTA has given a grace period. In case you have any credit that has already lapsed as on 1st January 26, that is the date when this change has been effective, that credit can be either utilized or applied for as refund up to 31st December 2026. So a very, very important change for tax registrants. We are recommending everybody that look at your ledgers, look at your credit ledgers, look at your refund position, and wherever you find that your credit might lapse has already lapsed, 5 years is already over, go for refunds, either utilize or file refunds, but ensure that action is taken by 31st December 2026. Otherwise, you end up losing that credit altogether. Now, there could be a few exceptional scenarios where this excess recoverable tax could be available, utilized, or refund could be applied for beyond a period of 5 years. FTA has explicitly given those scenarios and defined the additional timeline in which that refund can be applied. Now assume that the person the registrant was already under audit and the decision came in after a period of 5 years, which resulted in a credit which is lying to their account. Now, although the prescribed timeline is already over, in that case, if there is a excess recoverable tax that is arising due to a decision by the authority after expiry of 5 years, or in the last 30 days of the 5 years. So suppose your 5-year tenure was about to end and you got a decision in towards the end of your 5-year period with a window of 90 days. Then FTA has given a timeline of 1 year from the date the balance arises. because that so it would be unfair that that credit is not allowed. So in those exceptional scenarios, FTA has given an additional time window of 1 year in which the credit can be applied or can be utilized. Now, this is a very specific scenario where the credit comes up maybe because of a decision by the authority. But there could be many XYZ reason which probably FTA has kept the open window. Suppose you get a credit in your account due to any reason after expiry of 5 years or in the last 90 days of your 5 year tenure. In that case, again, FTA has permitted a 90 days window and the refund can be applied or credit can be utilized within 90 days from where the credit arises. So this is a very, very important change for all VAT registrants. We recommend go back to your books, go back to your accounts, look at your credit, do an analysis, ensure that your refunds are applied within 2026 to avoid losing out on any money on account of credit. Moving on to the statute of limitation. I guess most of you are aware, and we hear it every now and then that, okay, 5 year is the window when audit can be done. In case the 5 year window has already lapsed, there is no risk of audit or nothing can be done. Uh, it's interesting because that was not always the case. There have been some changes, but there were already always some exception to this 5 year window. We'll talk about the changes and already we'll also talk about the exceptions that already existed. So there are actually a few scenarios when audit may be conducted beyond 5 years. First is a case if the notification has already been made within the 5 year window. And I think this happens already that in case the notification or audit notification or assessment notification already came within the 5 year window, FTA actually has another 4 years to complete the audit. So if you see effectively the suggestion that documents to be maintained for 5 years actually fail in this scenario because you anyway have to maintain it for next 9 years in case you receive an audit notice. Now, there could be another scenario. Suppose you're sitting in the 5th year and you realized, okay, I did a mistake. I must have maybe paid some additional taxes in the previous, in the like, 5 years back. You file a VD and you may think that, okay, now audit cannot come because anyway, my 5 year window is closed. In that case, FTA has kept an exception that if you are filing a VD in the 5th year from the end of your tax period, then they have an FTA has an authority to conduct an audit or an assessment subject to the condition that they complete the audit within 1 year from the date of submission of VD. So this again leaves a window of 1 year for FTA to conduct audit. Third scenario. Suppose you had a refundable position. We are sitting in March 2026. We file a refund for a period which was 5 years ago. In that case, or another scenario where we are in 2026, we have the grace window of 26 to file all the previous refunds, and we file refund of 2018. In this scenario, although the 5 year period has already lapsed, FTA has an authority to conduct an audit or assessment. But again, the window to complete that audit is 2 years from the date of submission. So these two are very important provisions where VD or refund is filed in the last 5th year or in the grace period of 2026. This tax evasion clause was always there in case FTA suspects that there was a tax evasion or they suspect that, okay, the things were not always in order. They have an authority to go as back as 15 years from the end of tax period. So whenever any client asks me that what is the period for which I should maintain records, I always say 15 years, just in case we have some exposure in terms of where FTA conducts an audit, at least we have documentation to substantiate all our positions. Now, this is a very interesting amendment that has come in. Very often we are asked that if suppose you as a recipient receive a tax invoice and the tax invoice has some issues or the invoice is not compliant or you suspect that there might be something off with the vendor and you say, can I claim this input tax? It is not my compliance, it's vendor's compliance. As long as I have a tax invoice, I should be eligible to claim input tax. In that case, FTA has now introduced a new provision, which is Article 54 bis of UAE VAT law itself. And this change is again effective from 1st January 26. So what FTA has said is that in case there are suspicion of tax evasion, suppose you are in receipt of a tax invoice where you might suspect that this person has evaded tax, has not paid taxes to the authority. FTA fta reserves the right that they may actually reject your input tax on these grounds as well. Now, how could I know? Like, as a, the question could be that as a recipient, how could I know that the invoice was, the case was a tax evasion case? So, what FTA has said is that either you were aware of this relation, or you were in a circumstance where you could have known, it was your own negligence that you did not know. So you did not conduct your KYC, you did not check the validity and integrity of the supplies in that case. So I'll give you an very simple example. Suppose you receive a tax invoice and you have a TRN mentioned on the invoice of the vendor. You go to the portal and you punch in that TRN, and you find out that, okay, this TRN is not really giving me back any person's name. Then how is he giving me a tax invoice? But you still say, okay, okay, I have a tax invoice, let me claim the input tax. In that case, there is a high possibility that either the person has wrongly written their TRN, or they were registered at a time but are now deregistered and hence not paying tax to the authorities. In that case, FTA has now explicitly said that they reserve the right that they may actually reject this input tax on the grounds that you had a valid basis where this could have been a fraudulent case, and you still claim the input tax. So this provision actually is making the compliance more stringent, that have your KYCs and due diligence in place whenever you are claiming input tax against your purchases and expenses. So I'll now request Aditya to take forward the other amendments, the major amendment, please.
Yeah. Hi, good morning, everyone. Thank you, Harsha, for the introduction. So I'll be covering the key amendments in administrative penalties, uh, reverse charge mechanism, and voluntary disclosures. So begin with, so there are some amendments in the administrative penalties with effect from 14th of January 2026, where the FTA has given some relief to the taxpayer, and it is also to encourage the taxpayer to do the compliance on voluntary basis. So one of the case is where the taxable person fails to update his records with FTA. So whenever there is any change in the tax records of the taxable person, he has to update it with FTA portal within 20 business days. In case if he fails to do so, there is a penalty in old regime for 5,000 for the first time and 10,000 in case of repetition. But in the new regime, FTA has given some relief to the taxpayer and reduced the penalty to 1,000 for the first time and 5,000 in case it is repeated within 24 months. The second amendment is in case taxable person submits a tax return, but he fails to pay the tax due within the time frame, and then there is a penalty of 2% immediately after the due date, and then there is a penalty of 4% subsequently from the second month onwards on monthly basis in the old regime. But in the new regime, FTA has streamlined this penalty also, and and introduce a 14% per annum penalty, which is applicable on monthly basis. So this will also reduce the penalty burden on the taxpayers. Next one is the submission of incorrect tax return. So whenever a taxable person submit an incorrect tax return, he has to correct the error through a voluntary disclosure or in the through a voluntary disclosure. So whenever a voluntary disclosure is submitted, there is a fixed penalty of 1,000 in case this is a first voluntary disclosure and 2,000 in case of repetition. But now in the new penalty regime from 14th April onwards, the fixed penalty is reduced to AD 500, and this is also not applicable in case there is no tax difference. So if voluntary disclosure is filed for zero dated supplies or exempt supplies, then or some other case where the tax difference is not there, then the penalty will not apply. But in case there is a tax difference, AD 500 penalty is applicable. And along with this fixed penalty, there is a variable penalty also for voluntary disclosure, which is based on the tax difference. So in case of old regime, there was a penalty which was based on a slab, which is applicable from first year to fifth year. So in first year, the penalty is 5%, second year 10%, third year 20%, fourth year 30%, and 40% in the fifth year. But in the new regime, this penalty is also streamlined to 1% per month on the tax difference. So this amendment encourages the taxpayer to submit the voluntary disclosure as soon as they know there is a mistake. And as early as you file the voluntary disclosure, the penalty will be lower in the new tax regime, new amendment. Then, last but not the least, in case the taxpayer fails to submit the voluntary disclosure before being notified of a tax audit, suppose there was a taxpayer who was supposed to submit a voluntary disclosure and he knew that there is an error, but he did not submit the voluntary disclosure and audit notification came in. So in that case, a fixed penalty of 50% on the tax difference is applicable, as well as 4% monthly thereafter it is applicable. But in the new regime, this fixed penalty has been reduced to 15%, and the monthly penalty is reduced to 1% per month on the tax difference. So I believe these penalties encourages the taxpayer to do the compliance on voluntary basis, and these penalties are also more proportionate and balanced. So this is a welcoming move from the government, from the authority, that it encourages the taxpayer to do the compliance voluntarily. Moving forward, we will cover the amendment in reverse charge mechanism. Harsha, can you go to the next slide? Uh, First, before going to the reverse charge mechanism amendment, let us understand the penalty with an example. So suppose there was a tax return which was due on 28th of February 2025, and after that, the taxable person identifies that there was an error in the return, and due to that error, there is a differential tax liability of 100,000. So in the old regime, if he is submitting the voluntary disclosure, he has to submit before 14th of April. So let's suppose he submit a voluntary disclosure on 31st March. So this becomes the second year after the return due. So the penalty of 10% on the tax difference will apply, and a fixed penalty of 1,000 will apply in case this is the first VD. And there is a time-based penalty also in case the person fails to pay this tax difference within 20 business days from the date of filing the voluntary disclosure. We are assuming that he pays within 20 days, so there will be no time-based penalty, but the variable penalty of 10% on tax difference and a fixed penalty is still applicable. So total penalty in this old regime is 11,000. In new regime, the VD has to be submitted after 14th April for the new regime to be applicable, and the fixed penalty is reduced to 500, and variable penalty will be applicable 1% per month. So from 20th February 25 to 27th April 2026, which is we assumed. So these are 14 months. So 14% on the tax difference will be applicable. So it will be 14,000. So in new regime, so if the error is identified and is early the taxpayer pays file the VD, so penalty will be lesser. So suppose if the taxpayer submit the VD within 5 months or less than 5 months, then the penalty will be 4%, 5% only, as opposed to the old regime where the 5% is applied directly in the first year, and in the second year it increases to 10%. So this is the example. So in new regime, the FTA is trying to encourage the taxpayer to submit the voluntary disclosure as early as possible and reduces the penalty. Moving forward to the next amendment on reverse charge. So there's a concept in UI VAT law of reverse charge where reverse it is applicable on import of goods and services as well as some domestic supplies also. In case of import of goods, there is one amendment with effect from 1st January 2026, where a taxable person imported any goods or services in the UAE, then he has he had to issue a self invoice to himself, like he's making the supply to himself. He has to issue a tax invoice. But with effect from 1st January 2026, FTA has given some relief to the taxpayer that in case you receive an invoice from the supplier, then there will be no requirement to issue a self invoice. So this is like compliance requirement, relief in the compliance requirement for the taxpayer, but make sure the taxpayer has an invoice from the supplier. So this amendment is applicable only for the import of goods and services and not on the domestic reverse charge. Moving forward to the next thing. So from with effect from 14th of January 2026, authority has introduced reverse charge mechanism on domestic supply of metal scrap. So metal scrap are generally the ferrous or non-ferrous metal waste which has some commercial value or can be reused after the processing. So any supplier who supplies metal scrap, he can be covered under reverse charge mechanism if he satisfies some conditions. Like first condition is that the buyer should also be a VAT registered person. That means the buyer and seller both are VAT registered person, and the buyer is purchasing this metal scrap for resale or for using them for further processing. And this should not be an export. So only domestic supplies of metal scrap are covered under this amendment. For that to apply, the buyer and seller has to do some compliance, like the buyer has to submit a declaration to this supplier that he will be using that metal scrap for the purpose of resale, or he will be using that in further processing. And he is a VAT registered person. So these two declarations can be given in one single document to the supplier, signed by the buyer, and the supplier in turn will have to do one thing, that he will have to check that the TRN on FTA portal, that if the buyer is registered or not. So that compliance by supplier has to do. And when the supplier issues the invoice for that supply, he has to explicitly mention one statement in that invoice that this supply is subject to reverse charge mechanism and the buyer is required to charge or required to discharge the VAT liability under reverse charge mechanism. So these are the checklists for this amendment to be applicable. In case the buyer is unregistered, then normal provision will apply and supplier will charge the VAT. And in case the buyer does not submit a declaration, then the supplier will charge VAT on their own in absence of the declaration, and the buyer will not be eligible to claim the input VAT on that supply. So buyer has to submit a declaration to claim the input and to apply this reverse charge mechanism. So these are the key amendments which are introduced towards the end of 2025 and are applicable during 2026. In case any of you have any question, you can put your question in Q&A and we'll be happy to answer that.
Just to build a little bit on the change of reverse charge for metal scrap, we see a lot of questions coming from clients that they have a mixed metal product, which they are confused whether it qualifies for metal scrap or not. In those cases, we usually recommend that go strictly by law, because RCM is a more conservative view. If you're selling some goods as scrap, which may or may not be ferrous metal, then it is always better to take a forward charge approach rather than an RCM approach. Secondly, in the metal scrap industry, you will have a lot of buyers who are not very organized or are VAT unregistered. So whenever you are actually applying RCM, do ensure that proper due diligence is done, because in case the person was not VAT registered or they ended up not reporting tax liability, then the liability may actually come back to you. So ensure that proper documentation is maintained, proper checklists are maintained, proper declarations are taken. Ensure that you take TRN of your buyer as well. So have those checks in place before you apply reverse charge on metal scrap. So will if you have any questions, please feel free to write in the Q&A and we'll be okay. Faizan has a question. Can you let me know about the input VAT claim for the invoices dated prior 5 years? So FTA has not really explicitly said anything about invoices that are dated prior to 5 years about claiming the input tax. The amendment is mostly about refunds or excess recoverable tax that's lying in the account. But given they are putting a limit of 5 years on the refunds, it is always better that you take input tax timely and 5 year invoices as old as 5 years are not claimed. But if I talk strictly technically by law, there is no restriction placed on claim of input tax against invoices as old as 5 years, as long as recovery conditions are met to the extent that invoice is received now and intention to pay is established now.
Hmm.
Uh, does anybody else have any question? Please feel free to post it in the Q&A box or chat. Penalty. Uh, Aditya, there's a question for you. Penalty for tax payable at 14% on the tax payable amount.
Yes. So this penalty is 14% is calculated on the tax payable. In case this penalty relates to non-payment of VAT on the original tax return, then this will be applicable at 14% per annum on the tax payable amount and will be calculated on monthly basis. If the delay is 6 months, then 14% per annum will be applied for 6 months. So this is a per annum penalty will be proportionated to on monthly basis. And if this penalty relates to payment on voluntary disclosure, then this penalty will be calculated from the due date of payment. So in case of voluntary disclosure, the taxpayer has to pay the liability within 20 business days from the date when the voluntary disclosure was filed. So if the tax is not paid after 20 business days, then the penalty will be imposed from the due date of payment for voluntary disclosure, and it will also be 14% per annum, will be calculated proportionately.
There's another question. VAT amount paid within 20 days, then there is no penalty. I think you already addressed it, but yeah.
Yeah. So in case of VD, if the tax difference is paid within 20 days, then this time-based penalty will not be applicable. Only the fixed penalty and the 1% per month penalty on the tax difference will be applicable.
If you see this example, even if amount is paid within 20 days, there's still fixed and variable penalty that applies.
Mhm. Only time-based penalty, which is there, that will not be applicable if it is paid within 20 days.
We'll just wait for a couple of more minutes if there are any more questions. Otherwise, we'll conclude.
Yeah. Yeah, so
Uh,
Arjun has question. Yeah. Time-based penalty means the penalty which is applicable in case the tax difference is not paid within 20 business days. So three types of penalty are there in case of VD. One is fixed, which is applicable upon filing of VD. Then there is a variable penalty which is applicable 1% per month on the tax difference, which is applicable even if the tax is paid within 20 business days. And then the third penalty, which is time-based, basically this term time-based is given by us only. This is not in the law, but whenever there is a tax difference that has to be paid within 20 business days after filing the VD, and if that is missed, then 14% per annum penalty is applied on proportionate basis for the month or part of the month. So if the delay is for 1.5 months, then the penalty for 2 months will apply.
If a construction company sells the scrap, will we apply RCM for it as the buyer is not registered? Aditya, want to take that up?
Yeah. So there is no classification whether if the original business is metal scrap or not. In case any metal scrap is supplied, even if this is a side activity, this can be applied. But the buyer should be a registered person. If buyer is not registered, then this will not apply.
Okay. No, there is no law that has been. The question is that was there any law introduced that we cannot claim input VAT for dated prior to 5 years? No, there has been no amendment on time frame for recovery of input tax. The time frame for recovery still remains the same. The conditions still remain the same, that when the invoice is received or intention to pay is formed. It is just a general suggestion that invoice that date back as 5 years may be questioned, but no, there is no amendment in law that is placing a amendment to that when can input tax be claimed. The 5 year window has been introduced for any recoverable tax that is lying in your account where refund can be applied or can be adjusted against any payable liability. So there is no amendment that has come in recover time frame for recovery of input tax. Um, I think we do not really have any more questions and we can conclude the session. Ruchi, yes, we will be sharing the presentation and recording will be posted on our LinkedIn social as well. Or could be shared. Loganta will coordinate whether it is to be posted or shared, but the presentation will definitely be shared. Thank you very much. Thank you everyone for attending. It was a pleasure presenting to all of you. Be safe. Thank you.
Yeah. Thank you, everyone.